looking at several metrics that are telling us the economy is slowly getting back on track.
Yeah, that's right. Undoubtedly, those factories and firms are slowly getting back to work, with Bloomberg Economics estimating that as of last week, as much as 80% of the economy could be running at normal capacity. But that return to work has been very patchy. You have logistics and ports that are not fully operational. There are still millions of migrant workers that have been unable to return to work or are stuck in quarantine, although the national statistics say the majority have returned. But when you look at the energy consumption, there had been early optimism from an early pickup in energy usage, but you are now seeing that start to fall again. So a closely watched indicator of electricity demand is daily coal use by the coastal power plants of 6 big utilities. That was down 18% compared to a year ago. China's oil refiners, which supply the country's transport fuels, they've also slowed their return with slower processing rates. So this all pours cold water on hopes that there would be a fast rebound in China's economy that could also potentially support falling global commodity prices.
Right. And what we're talking about when it comes to the credit markets, though, I mean, it's pretty busy when it comes to issuance as well in China, and perhaps still seeing signs of this is being insulated, this market, from this panic selling that we're seeing around the world. But there's still some risks involved there. What are you watching?
Yeah, Vaughn, that's right. China actually had its busiest month on record in its corporate debt market in February. So a lot of this optimism about Chinese policymakers providing abundant liquidity has really helped support that $4.5 trillion corporate debt market. But as you said, those underlying risks haven't changed. Leveraged borrowers, especially in the private sector, face the same pressures that drove 2 record years of defaults in 2018 and 2019. And chief Asia Pacific economist at Natixis says that even though it may look stable on the surface, there's still a strong market preference towards issuances by financial institutions and public firms, and this places even more pressure on those private firms that have been hit especially hard by the coronavirus outbreak. So if you look at the pace of delinquencies, it's running at a record pace so far this year, and there's even been increasing scrutiny around the level of state-linked firms, how much support even those state-linked firms can be expected to receive after a top business unit of a top Chinese university defaulted this quarter. In addition to that, if you take a look at the pool of stressed debt, that remains elevated this quarter. And if the value of those China dollar bonds yielding at least 15% climb past December's record high of $25.6 billion, that's going to be a big signal of expanding risk.